Well, this year, Canada's housing market has faced the impact of tariffs, ongoing socioeconomic challenges, and even saw a new federal leadership. But will 2026 be a reset for the housing market? Let's get more on this from Philip Soper, CEO of Royal LePage. Philip, thanks as always for joining us.
My pleasure.
This year, tariffs was probably the word of the year for Canadians. What kind of an impact did that have on the housing market?
Our research showed it was the single biggest drag on housing activity. The interest rates moved from being a barrier to entry to being either neutral or even supportive. Employment was stronger than we anticipated. Generally, economic conditions were supportive. Yet you go out to consumers, you ask them, how are you feeling and what is bothering you if you're not making major decisions like automobiles or housing. Mm-hmm. And it was trade.
And do we know a number on how much it might have dragged things down, or is it just something that we know it had an impact?
Well, if you look at what the market should have done, given the other economic drivers, we're probably looking at 2 to 4% impact on home prices. And it simply was, home prices hung in there remarkably well, even in our most expensive cities like Toronto and Vancouver, but activity levels were very low. And when you have demand at lower levels and supply healthy, you're going to see slippage in prices. And that's what we saw in our two major markets.
And what other factors were driving it? We saw a population decrease for the first time. Was that an issue as well?
Yeah, the drop in immigration, temporary foreign workers, foreign students really impacted the condominium market, and particularly in larger cities. The individual investor supplies a lot of our rental stock in big cities. When interest rates peaked or mortgage rates peaked during the inflation spike post-pandemic, it made the math for small investors in rental stock, condominiums, just not work. They should have come back in 2024 and 2025 as interest rates declined, and they just didn't have at the rate one would have expected. And a big part of that was their clients, their tenants disappeared with the much smaller quotas on temporary Canadians or new Canadians.
Now, heading into 2026, are we going to see movement across the board, or will there be areas that may see improvement and some that will still stall, like condos?
Yeah, overall, we're seeing prices up next year by a small amount, just over flat, 1% in aggregate across the entire market. Detached homes higher than condominiums, detached homes in aggregate nationally up 2%, condominiums down 2.5% in our forecast. But very different looks in different regions of the country. We're seeing continued softening driven predominantly by the condominium sector, but not exclusively, in Toronto and Vancouver, whereas home prices in most of the rest of the country are expected to grow modestly. What I've been seeing over the last couple of years, you could actually go back to the end of a pandemic housing boom in 2020, the beginning of 2022, is compression, where our modestly priced cities have been easing upwards in home prices, home values, whereas our two most expensive greater metropolitan areas, Greater Toronto, Greater Vancouver, have been declining. So we're seeing that huge gap that has opened up over the last decade starting to normalize somewhat.
And is this more of a balanced market? Can we call it that?
Yeah, you know what? When you don't see home prices changing at above 5%, which is the long term, 50 to 75-year norm for house price appreciation in this country, you're looking at balanced markets. And if you look at other indicators, the ratio of sales to the homes listed for sale, they're in that balanced territory. In general, it's not a bad time for homeowners. They're not seeing that 5% appreciation, but they're also not seeing a material decline in the value of their homes. And if they are trading up, obviously, if there's a little bit of a difference between what their home is worth and what it was worth, that's going to show up in the home they purchase as well. The big difference is that it's a more supportive environment for younger families, for first-time home buyers. They can add conditions into a deal, and home prices are softer, both in suburban and urban areas of our most costly cities.
And we're almost out of time, but I just want to ask quickly, the government, there was a lot of talk with the new government about homes and helping in that. What do you see happening over the next year when it comes to the government involvement?
It needs to be multi-level. It needs to be municipal, provincial, and federal. All levels of government in most regions of the country are saying the right things. The new federal government's policies are supportive and thoughtfully integrated across all the elements that drive housing. The proof will be in execution. Okay. Can we move policy ideas into actual shovels in the ground, increasing supply and providing that affordability lift for young families?
Okay, we'll have to wrap it up there. But Philip, thanks as always for joining us. All the best for the new year.
You too.
Philip Soper is CEO of Royal LePage.